listings. So people are looking, it's really making do with what you have, and that's what that liquidity concept is about. The CDSC is behind that through a screen-based platform. We are looking at other liquidity management tools like market making. We are also looking at short selling. And I think we've already seen some development with regard to, I would say, short selling or market making specifically when it comes to derivatives, and that, despite the fact that the figures are still low, but they're substantially higher than they were when we set up the derivatives exchange. Right. So particularly on intraday trading, and it's very important also to note that there was an upgrade of the NSC and the CDSC market infrastructure. For NSC, it was the trading infrastructure, and for CDS, it was the clearing and settlement. But what was important that it allowed now for things which were hitherto not possible to achieve. First, you're able to now have multi-assets traded, not the traditional equity and debt, but you can now have GDRs, you can have ETFs, all sorts of assets. And speaking of just a little more on intraday trading, what NSC has brought to us to review before they roll out is non-leveraged intraday trading, where that still requires some level of validation, whether the shares are in your account, whether you have that money in your account. But what is important, and just linking it with that excitement, we want to see investors, especially the youth,
wow. You
just need to employ those liquidity management tools. And of course, we've been told about CBK also coming up with theirs that will have both a trade reporting, clearing and settlement functionality. But ultimately, what we intend to achieve as a short-term recovery strategy for the capital markets is to make sure that we have supporting infrastructure for all these liquidity enhancement tools, which I'm happy to note that the CDSC and the NSC have been able to achieve through upgrades.
Okay.
And also very importantly, I think the participants have not been too amused about in the past downtime. So the upgrade has really, to a very, very large extent, I don't know when you last had, there was
that's a good point. Thank you very much, Mr. Ombar. Let me take it away and look at another pillar. One of the other pillars that this report, the Africa Financial Markets 2021 report details, is Pillar 5, and this focuses on the macroeconomic opportunity. This question is for you, Ms. Anzetse Were. Kenya was ranked 13. Is this good? Is this bad? What measures need to be taken to improve this particular ranking?
So let me just say that the macroeconomic environment has been defined by two things in Kenya. There are many, but there are two. One is fiscal stress. The other is the economic impact of COVID. Okay. If you look at the fiscal stress part, all parts of our fiscal policy have been struggling. You know, whether that's the expenditure side, where we have problems with under-expenditure and poor quality spending, whether it's the revenue generation side, where we've had an 8-year decline in the share of revenue to GDP. Government's having a very difficult time getting enough revenue to meet its expenditure. And as a result, we're seeing this massive increase in debt. Okay. And so the debt question, it's not just that it's high, is that our debt stress is up and rising, and our debt risk is up and rising. It's not like that's being resolved right now. But the impact of fiscal stress is that it really undermines the ability of particularly government spending to have a constructive effect on the economy. So you sort of have that siloing that happens between what government is doing and its real impact, particularly when you look at things like pending bills, which is part of the expenditure problem, where the bulk of pending bills are to private sector. So let me just say that that fiscal stress means that the economic impact of COVID has been quite pronounced. We saw the first contraction in our economy in about 30 years last year. Yes. That is significant. And when you look at the varied impact that COVID has had sectorally, you'll find that it's the services sector. With the exception of finances and ICT, it's really the services sector that contracted severely. And the services sector is the engine of our growth. It has been since about 2003. Now, what that has resulted in is a drop in aggregate demand because people have lost jobs, people have lost incomes, and so the private consumption of our economy, which is another key engine, that sort of collapsed.
Okay.
Now, the problem that we're having macroeconomically is that when you're looking at the policies that are being employed to foster fiscal survival, they're quite at tension with the policies you need for economic recovery. So when you look at the fiscal survival policies that are being deployed right now, government is trying to make sure it's got enough cash flow on the expenditure side. Government is trying to do what it can to make sure we do not default on debt, because that would be catastrophic. And then, of course, you're seeing this push in revenue, yeah?
Yes.
These very aggressive tax policies that can be quite counterproductive when it comes to sort of economic recovery. So what you'd want from an economic recovery perspective is you'd want a deep demand side stimulus that expands cash transfers, because 2 million Kenyans have fallen into poverty. Let's not forget that, 2 million.
Yes.
These were previously financially independent and economically active Kenyans. So what you'd want there is like a very broad demand side stimulus. You'd want some tax relief. Firms have closed down.
Okay.
Firms are performing under capacity. You want some relief. You want some grace. But you can see how those policies are quite at tension with the fiscal survival. So until those tensions are managed, you're going to continue to see this deterioration in the macroeconomic environment, and it will only more deeply inform this sort of risk aversion that formal finance has in sort of deepening, particularly the retail solutions. It's a fundamental structural issue that will have to be resolved going forward.
All right, two things that you're bringing up, and I'll actually tie into that in terms of we're getting into an election cycle. So do things get worse? Do they get better? And the second part of this question, based on where you sit and the interactions that you have, can this issue of debt distress, the issue of fiscal stress, can it be resolved? And what are two of the things that absolutely need to be happen or we need to be paying attention to for us to be able to move forward? And that's it. You could take that. Yes, this is the second part of the question.
Sorry, I thought
sorry.
you were afraid. Yeah, so I think the real challenge that we're seeing as we're going into the election period is the profile of the new poor. So you've got a situation where incomes have been decimated, incomes have been reduced, job loss. And when you look at the micro level, because we track this on a quarterly basis, we're looking at the household and firm level. Okay. We're seeing Kenyans going into very desperate behavior like selling assets, really eating into their savings, missing meals. So when you're looking at going back into a point of position of economic recovery, unless there's significant external support deployed to a bulk of households in the economy, it's going to be very difficult for people to even recapitalize and restart their businesses. So I think that's why really looking at the profile of the new poor, and the World Bank report indicates that they're younger, they're more educated, they're more urban. These are people who can be very economically active. It's really important that we extend that with the money, particularly because when you look at the debt profile that Kenya is having, since COVID started, our debt has increased about 23%.
All right.
Since COVID started.
Is it at a national or at a personal household?
When you're looking at the blend of debt, that becomes quite technical. When you're looking at sort of the debt composition, it's varied. Government has been trying to get into more concessional, multilateral lending, but we just did a Euro bond, we just did an infrastructure bond. Yes. Those are commercial, those are very expensive. But the reason why those are preferred is because they're quick, and you're able to have a lot of independence in how you deploy that. Yeah? That can be a good thing or a bad thing. But that's why I'm saying if we can think about how we can channel our expenditure to the economic recovery questions, because those are quite serious, and we need to start supporting households and firms, particularly those that are beginning to fall into poverty.
Oh, wow. I feel we need a whole 1 hour, but my last question for this particular, I hear you on the element of supporting households, but then on the flip side, you are also saying that the funds that the government is raising, those funds are not sufficient to meet the kind of expenditure that we have. So then how does that gap, how do you actually support households? Is that even possible?
Yeah, it is possible. One of the things that FSD does is that we've been partnering with government on the cash transfers, you know, Ajami, all of these. And it is very possible to expand the breadth that you're doing and then the depth. The thing that most governments haven't done, and we've been trying to support government here, is what are your fiscal costs to deploy that enhanced, and then what is your multiplier? All right. And until you figure out what that balance is, to say if you deploy this much, this will be the fiscal multiplier, therefore it makes sense, that's the work that's not being done. Because I think the struggle is that there is a cost to spending more, but there's also a cost to not spending. Because guys will continue to be poor, your human capital will continue to deplete as kids get out of school, as people don't become economically productive. So that's the other tension. If you're looking at the macroeconomic tension, it's that tension of do we spend more or do we spend less? And then that fiscal survival versus economic recovery. Those are very real tensions that are being dealt with that are quite important.
All right, thank you so much. I'll just have a follow-up question from Mr. Kirui, and then I'll be able to start taking questions from our audiences. Kindly remember, if you have a question, I'd highly encourage you to come over to the mics. They're on the sides of the room. If you are joining us virtually, our hashtag is hashtag AFMI 2021. We'd like to hear your questions, your comments. If you are joining us on the webinar, please put in your questions and your comments on the chat section. Now, Mr. Kuri, just riding on what Ms. Anzetse has brought up, again, on the pillar of number 5, we are saying that there is an element of debt distress. Then the IMF as well says that Kenya faces the risk of debt distress. How have the financial markets priced this risk in, and what is the medium-term outlook when we look at the debt situation in Kenya?
Thanks, Bithe. And definitely this has been quite topical over the recent years, months. And I think it's important to note that the IMF also says that the debt as it is at the moment is sustainable, although the risk exists, and has also commented, I think, in the same statement that the outlook is also positive. That being said, Kenya recently entered into an IMF program and is looking at a ECF and EFF program, Extended Credit Facility and Extended Funding Facility, which amounted to $2.34 billion, a 3-year program which also had certain benchmarks or requirements that the government had to meet both on its fiscal deficit and its debt ratio over the period. And I think this is particularly important for external investors, global investors, and even domestically, because there is a program with certain disciplines and a guideline that the government needs to meet. It's not the first time that we've had debt levels at these levels. I think back in around 2000, they were as high as around 77% of GDP, and they dropped to around 53% somewhere in 2013. So it's very much a road to recovery, and I think, as Anzetse says, there's that tension between how do we support vulnerable groups, which is one of the agendas of this ECF, EFF program with the IMF, while at the same time, how do we promote recovery from COVID, and then also address external debt vulnerabilities. And I think that's a key indicator. I think looking at how our Eurobonds have done externally, I think more recently we've seen them reverse some of the gains that they had earlier in the year or around the middle of the year. But certainly price-wise, they've recovered from lows we saw in 2020 and are trading at around the 2019 level. So, you know, in some ways that is positive. And we did see a healthy participation in the recent issuance in June when the 1 billion that came out at around 6.3% and was 5 times oversubscribed. So there's definitely external appetite. But it doesn't mean that we should rush out and grab as much as we can. It's really very much a way of how do we manage that responsibility of funding and meeting the needs to propel growth, because at the end of the day, the debt ratio is also driven by our GDP growth. If we're able to fuel GDP growth and sustain that while managing debt, it allows us to address the debt ratio concern. And I think it's part of that balance that Anzette has talked about. I think there's the opportunity to look at how do we restructure our debt, and that's very much what the government has in mind. I think PPP programs is one part of that. And then also how do we lengthen the tenor of our debt. So on the domestic market, that's been done a lot more deliberately. And there's been a strategy to move away from relying on T-bills to look at longer dated securities, and also the blend of external versus domestic, because of course with external debt you're vulnerable to other risks like exchange rate risk, etc. So I think those challenges, balances, risks and opportunities is something that we are faced with, and has been complicated further by a lot of what the panelists have talked about, or the environment we're in. And it's very much how do we recover from this without kind of not losing our shirts. and actually get us on a path to a steady recovery, appreciating that it will take time.
Okay.
And there will be some tough decisions that need to be made.
Okay, so time and patience. So unfortunately, we've come to the near end of our conversation today. I will be able to take in any questions. I'll highly encourage those of us who are sitting with us in the room, kindly, there are mics on the sides of the room. If you can kindly approach them, I'll be able to take a question or two. However, from our online audiences, that's our hashtag is AFMI 2021. Please put up your questions there. I'll be able to direct one question at least to every panelist, but I'd also encourage our panelists to prepare your closing remarks in regards to anything pertinent that we are not able to capture. I have a question for Mr. Geoffrey Odundo, who is the Chief Executive Officer of the Nairobi Securities Exchange. Mr. Odundo, your question is from Moses Jigona, and he's asking, are there plans to have MTN Uganda cross-list to the Nairobi Securities Exchange? Will there be new IPOs out of Uganda in the telco space due to their laws, and how are you positioning the Nairobi Securities Exchange to take advantage of this?
Thank you very much. That's a very good question. The MTN Uganda is actually now open and pretty attractive issuance, quite attractive, and we're happy for Uganda. It's a long time coming for them. Now, regionally, we have a platform where we work together as regional or partner states and partner exchanges, and I believe that with time, opportunity to cross-list MTN in Kenya will happen. We currently have a listing from Uganda and a listing from Rwanda, and Kenya happens to be a very deep market and has given better price valuations for those particular companies. So I think we'll be looking into that. Of course, we have very good conversations, but of course, let them have their time as a primary market to also be able to sell. This is an IPO open to East Africans. We have already got agreed arrangements on how East Africans are recognized when it comes to IPOs, and I believe Kenyans will have an opportunity to invest in that. On our part, we are focusing on building the supply side, as Luke had spoken to.
Yes.
Telco sector happens to be one of the most important sectors for us. So the telco companies in Kenya, we are continuously engaging with them. We haven't had, we don't have any compulsion policies that are linked to their licensing, like in Uganda and Tanzania. It's something that possibly, I don't know, it will be explored in future.
Okay.
But we are encouraging just voluntary listings and issuances because we are a free market.
Okay,
and,
fantastic. Thank you so much for that response. I can see we have one of us in the room. Please remove your mic, tell us where you're from, and ask your question. Thank you very much.
Thank you. Can I be heard? Yes, thank you. Thank you very much, everyone. Two questions very briefly. One is on the index. Let me read something from Pillar 5. Kenya publishes the schedule of the next upcoming MPC meeting. Only countries that publish a full year schedule and full marks. And I'm wondering, isn't this a very low bar? Because if you look at the Nigerian central bank, if you look at the Ghanaian central bank, they give you the full detail of an MPC, including what every member was thinking about, some of the off-the-cuff conversations they had. So I'm just looking at this benchmark and wondering whether it is really setting the bar so low. I'd like a comment on that. Then to Mr. Ombara regarding the exciting the market. Sometimes I really empathize with our capital markets because, as you rightly observed, listings globally are dying, for the lack of a better word. We have seen in other jurisdictions the adoption of mandatory disclosures for public interest companies, such that it only makes sense for them to list. So if you look at the Kenyan scenario, is there a reason why, for example, Bidco isn't a public interest company? Chandaria isn't a public interest company? And would that be the avenue through which then you can catalyze new listings? Thank you.
Thank you so much. I think I'll start with the last question, Mr. Mbara.
Yeah, thank you very much. I think there's that's a true statement. There've been supply side concerns, and we looked at various alternatives. I think I alluded to that earlier. We said, why don't we have, because again, speaking of that excitement, it came through the privatizations via the capital markets, where you had the KCBs as early as the 80s. So we said, perhaps, why don't we look at few large companies, because it's also going to address the issue of concentration alongside even just that shortage of listings and access to assets. So we looked at, can we go the mandatory way, and I think Uganda has moved that way. We've seen Ghana. Ghana actually, when I was speaking with the Director General a few years ago of the Securities Commission, he said, as long as you're a multinational company, before you get your, you have your lease, and before it expires, one of the conditions is that you need to be listed because you're public interest and several other. So we tried to put that across to stakeholders, and they seem to be more persuaded that there's a way in which we could be able to just convince these large companies to come to the market rather than force them because you've achieved a certain capitalization requirement, then you must come to the market. But we have support from the National Treasury when we went to them and said, yeah, there's some really important strategic companies that really, by virtue of their size and their impact on the livelihood of Kenyans and even beyond, it would be important for them to necessarily disclose information that financial statements and all that, just to provide some level of comfort, because if they collapsed, for example, there could be as much as systemic risks.
Yes.
So it's something that, to be very straight with my answer, it is something that we have anticipated. If you're too large, if you're a multinational company, if you're in a utility sector, you're in the energy sector, you must mandatorily list. It's worked in Ukraine, but ultimately there are also the flip side to it, because it could come in the market, then it becomes again illiquid. So we are trying as much as possible to take a persuasive approach, come up with the correct infrastructure, correct incentives, review, and you'll permit me, I think it's the first time the regulator didn't talk about the regulatory framework, because it's expected that we are going to talk about it, but there's a lot more than just the regulatory framework. So we are just reviewing for example, the public offers listings and disclosures regulations to try and remove some of the bottlenecks, like free float, minimum number of shareholders required, and also trying to work on the tax framework where we can be able to provide some kind of incentives in terms like tax deductibility on expenses relating to public offers or listings as a persuasive approach. But we can't rule out the mandatory route.
All right, thank you so much. I'll probably pass the question with regards to transparency on MPC minutes to Mr. Kirui, and as you answer that, please prepare your closing remarks as well.
Okay, thank you, Etha. I think it's a good question, and I think what we need to consider is, okay, it is part of that pillar, but also the evolution of the index itself. So very much like we have launched ESG this year, when we introduce metrics or measures into the index, we don't necessarily start at what would be the highest level of transparency or the highest standard. We want to start at a standard that a number of countries can meet, and over time as the index evolves, we then raise the standard, and that is the case this year. So we've been running the index for 5 years. Countries, in some cases, never even announced when their next MPC meeting will be. You start to now introduce a level of calendar for the whole year, and then some of the detail that the person who asked the question earlier will start to then come into part of that measure. And I think that's the spirit behind the index, because we're trying to encourage development. We're trying to encourage our financial markets to lift their standard. And I think that's really the principle behind it. So you'll find that the index will continue to evolve.
Okay.
You've seen tech, you've seen ESG, you've seen some refinement of some of the other measures, and that's what the index reflects. And you'll find over time countries will rise and fall, but through this we're able to actually get a better idea of what is the standard out there, not just globally, but what are some of the peers in the market doing. And that gives us a way to compare ourselves and continually improve.
All right, thank you very much. Mr. Geoffrey Odindo, your closing remarks, please.
So very happy with this. I think the sequential reports coming out, I think it just brings out areas of us to standardize and also compare various markets. I must say that from the NSC perspective, I think we'll continue to play our role. Just to the point about the economic question, what the report could also do as part of improvement is also look at the infrastructure spend and come up with sort of some measures on how this can then be also recognized in this report, because Kenya has done very well in terms of infrastructure development. But you see, that's not factored in this report, so we're focusing so much on the debt and the physical stress and leaving out also the future plans that we've done, because you cannot grow an economy without infrastructure. I think that's very important. To the point of the fiscal stress, the NSC has solutions towards that as well. We can contribute to that. Luke spoke about getting government to divest through the stock market, to do additional sell downs. We've been able to advance this case, and it is merited. That's how you'll be able to reduce the pressure on domestic borrowing. And then once you reduce the pressure on domestic borrowing, you'll then allow the banks to be able to lend to the needy sectors, especially SMEs. And interest rates will come down, and then you'll have a multiplier effect, just like we did in 2002, when you saw interest rates drop to almost 1%. So that can still be achieved, but it has to begin. The process has to begin by looking at what's available in the capital markets and any other alternative sources.
All right. Thank you very much, Mr. Rodundo. Your closing remarks kindly, and Zatsaware.
Thank you. I think, yes, I do echo that this is a very useful index. I think what would be really good going forward would be a deeper analysis of the interface of financial markets with the real economy, because that's where the bulk of African and Kenyan labor sits, and looking at the real bottlenecks that are preventing this massive liquidity from having a deeper macroeconomic reach. I think that's the first thing. And I think the second thing that would be very interesting is the role of financial innovation in the financial market index. I mean, in addition to what the other panelists have said, Kenya is leading a lot, not only in the fintech innovation space, but the financial innovations that are coming out of sector-specific tech, like agri-tech, ed tech, all these other types of tech that are creating very creative ways of getting, creative retail solutions in particular to market. So I think if you could also deepen that side of things and then sort of continuing to encourage this new introduction of the ESG, I think that's very important going forward.
All right. Thank you very much for that. And last but not least, Mr. Luke Umbara from the Capital Markets Authority.
Yeah, I think we have a lifeline in innovation, particularly in the area of fintech, which I think we have very good developments in the Kenyan capital markets. And as we speak, we have 9 fintechs that have already being tested in the CMA regulatory sandbox. That's against what our expectations was. 1 would be done per year, but we got 9. 3 have already exited. 1 is already very active in the mass market. That's a crowdfunding, a debt crowdfunding platform. There's also 1 that's dealing with data analytics. So really also addressing the issue that Jeff raised around valuation through getting all the information together. Okay. And I think the 3rd one that's on crowdfunding is like a CIS. It emulates a robo-advisory solution, but in dollar terms. So I think bottom line is, if we're able, like if you look at the rest that are already undergoing testing, like the CDSC screen-based SLB platform, there's also 1 on KYC. There are a lot of concerns around how you can decentralize, for example, KYC, fit and proper. As a regulator, sometimes you have to keep on writing to the primary regulator if it's a foreign-based company coming on board. And that's a lot of inconvenience, even for the domestic investors that we're talking about in terms of onboarding. So ultimately, if we're able to get 1 or 2 that will have an impact like we had of M-Pesa, I think we'll have done our job. You're able to do the KYC, then that removes one of the main bottlenecks to coming to the market. And then finally, we really have to appreciate that as much as we are focusing so much on the retail or investor side or demand side, okay. Yes, as much as we have diversification, and we have so many products. I think Jeff said we are number 2 in the continent. The keyword there is uptake. So we need to do a lot more. We need to start asking ourselves, why don't we have county market-based financing, for example? Why don't we have Sharia-compliant products or participatory finance or Islamic capital markets? Why aren't we having a rollout in asset securitization? So it's good enough to have the products, but we need to really, really examine what's stopping us from uptake. We are very certain about what we are going to do from the demand side, but from the supply side, again, you'll appreciate that's a business decision. Sometimes it's also a national decision because government might have a position on whether, for example, counties can do a county bond. So we have to bring in all those perspectives. So the solution, in short, I'm saying, is leverage technology and then look at the issues that are affecting uptake, particularly on the supply side.
All right, thank you so much. Ladies and gentlemen, that was our panel talking about a sustainable way of actually enhancing the access and the opportunity set when it comes to Kenya. I'll kindly ask our panelists to exit from this side of the podium, and as we do that, we are coming to the tail end of today's conversation. Mr. Anthony Kure, please take on the podium for the closing remarks. Our panelists, thank you so much for your time and your contributions. Kindly exit on the right side of the podium, and thank you so much. We are still taking your questions, your comments, your feedback. Our hashtag is hashtag AFMI 2021. We are having this conversation on the back of the Kenya launch of the Africa Financial Markets Index 2021. We are coming to the tail end, but we still want to hear your engagement. So please keep your questions and your comments coming. To close this off for today's conversation, we will have Mr. Anthony Kirui, who is part of the Absa Bank Kenya team. Over to you, Mr. Kirui.
Indeed, thank you, Bithe, and thank you to all those who are here today. I'd like to kick off by thanking all those who have been able to stay with us as we kick off our launch for Kenya of the 2021 AFMI report. And I thank you for all sticking with us as we've had a few technical challenges. But that being said, this is part of the nature of doing things on our continent as we continue to strive to grow and strengthen our business environment. Let me start by thanking all of our panelists and our participants, those online and those here in the room with me. We appreciate your time. I think the AFMI report and the discussion today continues to underline our commitment to providing our clients as well as our wider stakeholders with relevant information and insights into the growth of that can help to inform the growth of their organizations and the market at large. As part of one of the leading financial services group on the continent, we remain and committed to continuing to play our role in the development of the continent and financial markets to make them globally competitive. As an organization, as a firm in this market, we provide a wide array of financial services ranging from banking, insurance, wealth, and asset management, as well as structured investment solutions. In line with this commitment, this year we have launched several client-facing initiatives, including our Women in Business proposition, which targets to support women entrepreneurs with better access to finance, information, local and international markets, as well as mentorship. In addition, we have launched the Absa Asset Management Limited business, which provides investment opportunities across the spectrum, and I want to welcome you to talk to us so that we can partner in your growth journey. Let me also say that Absa has made a commitment to champion sustainable business practices through green financing, and we are signatories of the Principles for Responsible Banking, as well as the SDGs. Last year, we also launched our Sustainable Commitment Report, in which we outlined key sustainability parameters that would guide the development and execution of our strategy. Lastly, let me invite you to study the AFMI report And if need be, we're available to have deeper and more structured conversations with our clients and various stakeholders. We welcome your questions and engagement, and indeed, even after this event, those online, please feel free to continue to reach out to us as we continue to engage. Once again, I want to thank you very much for making the time this morning. In particular, I want to thank Jeff Odundo from the NSC, CEO of the NSC, Luke Ombara from the CMA, and Zet Sewere from FSD Kenya, our very own Jeff Gable, and Natalia from OMFIF, who joined us online. Thank you for sharing your knowledge and your insights, and I wish you all a great day and a great week ahead. Thank you.
Thank you so much. That was Mr. Anthony Kuri giving us the closing remarks. And now we have come to the official end of the launch. We were discussing the Africa Financial Markets Index 2021, brought to you by Absa Bank Kenya. A lot of insights from the start with opening remarks, then the one-on-one presentation, which was touching on 6 pillars, looking at where Kenya is positioned vis-a-vis other 22 African countries. We've had an extensive conversation with regards to the panelists who were talking to us about how do we create a sustainable future in light of the Africa Financial Market Index 2021 report. Now, a lot has gone on, but we still encourage you to be able to give us your feedback and your commentary. It has certainly been an honor and a privilege to be able to bring all of these conversations together. In as much as there's a lot going on, the future still does look very bright. The opportunities for growth are immense in Africa, and the insights brought to you courtesy of Absa Bank Kenya are immeasurable in terms of showing you how to be able to navigate the opportunity set for investments in Kenya. My name is Mbithe Mwema. I am the Chief Executive Officer of Infallible Group. It has been an honor and privilege to be able to moderate this event. We have come to the tail end of it. Thank you for your time, for your participation, and do have a great day ahead. God bless you. Kwaheri.